Hey Bill, how's it going, man?
Doing well. How are you today?
Good, good. So, for anybody that's listening that doesn't know Bill, I'm going to give overall introduction. So, Bill Faeth is, as he claims himself as well, an entrepreneur, a family man, and a business coach. He has over 20 years of experience launching 24 startups, including an inbound marketing agency. He's been in the real estate space for 25 years. He's been in the short-term rental space for multiple years as well. He coaches students how to get into short-term rentals, and he's been throwing one of the biggest short-term rental events to date. So, Bill Faeth, is there anything else I'm missing on
No,
that?
that's kind of embarrassing. I'm actually, but no, actually, there's more. Keep it coming. I'm just kidding. No, that's awesome. Yeah, no, I appreciate it. And then you and I just met in person recently at another event, TJ Tajani's event.
Right, right.
And then you're having an event that's coming up in about 2 months, right?
Yeah, so having an event coming up, it got inspired by you, Bill. So you definitely set the tone, and hopefully we can deliver to some degree. And I'm excited. I'm excited to
Well,
kind
look,
of
I
get a
mean, Michael
community
Schroeder
together.
and I put on a great fucking event. It was pretty. I'll say that myself. I usually don't self brag that much, but it was the best event in the history of our industry.
Oh,
Though we
100%.
missed a couple of things, right? That I really like what you're doing at your event, and I really wish I could be there. You're going to be more focused on like networking and workshops, and that was the only negative, Patrick, that came out of our event is that we didn't have enough, networking opportunities. So we live and learn, and I'm excited that your event, I think it's in October, STR Nation in Vegas, is going to be focusing on that part because we missed it.
Right. So you did announce your new event coming up, right? So can you tell us
Not
a little
really
bit?
officially. I mean, I guess not. I kind of softly have teased
Okay.
some things about it in my Facebook group. We haven't really
Right.
announced it. Michael and I have our STR conference retreat coming up. This is not a sales pitch. It's sold out in Miami. I think you're going to be there, right? September 11th through the 14th. And actually, I just got back from Miami last night. I just had my mastermind meeting there. And it's going to be awesome, but we're going to announce it there. The dates are March 20th through 22nd. We will be back here in Nashville. We will be at the same venue. It will be a completely different event. And, I'll just give a prelude. We've got, I don't even know if I have it here. I think here we go. I thought I gave it away, and I can never say his name correctly. Mike Malowitz, who wrote The Pumpkin Plan and also Profit First, is going to be our keynote speaker. So I think it's kind of cool to have somebody that's really focused on business, not necessarily STR specific. I can tell you that I've had two books kind of really shape my business outlook in the last 15 years. One is a book that every single entrepreneur should read. It's The E-Myth by Michael Gerber, The Entrepreneurial Myth. And everybody says work on your business, not inside your business. It's just the perfect anecdote for that. And then I love Pumpkin Plan, but Profit First is something that I kind of did it, but now I have a total new perspective on that. And I think a lot of new entrepreneurs, when we struggle in the beginning, and specifically like with STRs as an example, we don't pay ourselves, right? We pay the mortgage, we pay the insurance, we pay our cleaners, and we don't pay ourselves. I pay my business first for everything, and then I pay myself second. So, but I pay myself before I pay my staff. It didn't used to be that way. And that may sound crazy to somebody that has a job, a W-2, but if I don't pay myself, then I lose interest in the business. If I can't survive, then they're not going to have a job. There's a whole lot of psychology that goes behind it. And I'm super excited to have Mike as our keynote speaker.
That's awesome. And I haven't, that's new news to me as well. So
nobody
that's
fucking knows. You're the first one, Patrick. Don't tell anybody.
Don't tell anybody. So that's awesome. Thanks for sharing. So I actually read Profit First, and it blew my mind. It changed my business. And actually, that's something I wanted to ask you, Bill. Do you think that short-term rental operators, you're running a real estate business, right? At the end of the day, a hospitality business. Can you maybe talk about a little bit of why you should be reading business books to get into real estate and that kind of thing?
So, yeah, I mean, I think what happens is people stay super narrow in their lane if they become a plumber, if they become a public speaker, if they get into real estate. Now, okay, well, I don't need to know anything about multifamily because I'm in the STR space. I don't need to know anything about boutique hotels because I only buy single family homes, right? Well, things have shifted dramatically. Like I'm buying motels and converting them into boutique hotels right now. I just got a phone with one of my bankers in one of my markets. I'm buying a duplex that's $1.9 million. I'm not buying single family homes right now. And if I am, it's below that like $650,000 price point because everything's just too inflated. So if I would have never moved into exploring single family or multifamily homes and learning about how that model works, I would have never been able to get multifamily funding and also exits on single family homes. And there's a lot of people that don't understand how that works, right? So I had to learn. I learned from Brandon Turner. I learned from, Uncle G and how that stuff works, right? Yeah. So what happens, I'm just going to walk you through a scenario. If you don't mind, I'll be a little bit long-winded here.
No, go for it.
I just put a property yesterday under contract in Hot Springs, Arkansas. They're asking $645. We asked $600. They came back at $625. We did one more counter. We said, we'll give you $675. So why the heck would I go from $625 and not just say yes to go to $675? Because I'm also asking for a $50,000 credit at closing. So one thing that does, that eliminates me from going to a DSCR product because you can only max out your credits back at 3%, right? Which is fine. Had no intention of doing that anyways. We're using a local community bank commercial loan, but because we're basically doing ARV, we run mega performas, we have all of our shit together, right? So I've got a couple of partners in this, and this is for my fund that I think I've told you started a syndication, $100 million. Right now, there's a personal net worth of about 30 million between the three partners, but we still show our tax returns. We have everything on our PFSs. We deliver 6 pro forma models based on current rental income, future rental income, and multiple rates and expenses, right? So, but we're doing ARV, that is after renovation value, for those of you that aren't familiar with that acronym. And that's why we're asking for the $50,000 back. So that way we'll go in and it's almost a turnkey property and it's undervalued right now by probably close to $120,000. We're going to have immediate equity and we can do one of two things. We can use that $50,000 to furnish, or it's going to take us about 120 to close. So that's 50,000 each. Well, that's about roughly 16,500, 17,000 bucks. So now we lower our cost basis down to roughly $23,000 each, which is going to dramatically increase our cash on cash return, right? So if I wasn't continuing to learn, if I wasn't in mastermind groups, if I didn't read books like Profit First or The Pumpkin Pan or, Traction or The Art of the Starts or all these, Brendan Burchard, High Performance Habits, these are all, and that's why 5% of my book collection, right? One of the things we have to do is we have to explore, we have to open our minds, and we want to learn outside of our niche. So you talked about 24 startups. I've done 31 now. You probably found a bio, probably my LinkedIn or something that's outdated. But I've been in the restaurant business. I was drop shipping in 1993, actually Brazilian swimwear, my first exit out of a company. Swimwear, selling t-shirts out of the back of my car. Restaurants, grew up from 1 to 6, turned it into a franchise, sold it. Been in real estate for 26 years now. Marketing agency, limousine company, you name it. I've been in all these different industries, but here's the thing. Business principles, the same business principles apply to every single business. And for many, many years, it's been the American home, what I'm in right now, and you're probably in, is the biggest investment you'll ever make. Well, that was the same for me until I started getting into short-term rentals and real estate and buying bigger properties. So I paid like $726,000 for my house. Sure, it's worth $2 million today, and I put 300 into it since then, but I didn't write those. My house in Banner Elk I bought it closed in April. I put $420,000 in cash down and roughly $85,000 in building out a game room and furniture and just all the post-closing stuff. $505,000. That's a $500,000. That's a lot of money. Mm-hmm. People's huevos are going to shrink up if they've never done that before. So one of the things about the due diligence on the front end, when I talk about that preparation, the evaluating properties, the performance, figuring out NOI, running multiple scenarios, 20-year financing, 25-year financing, seeing if you can get owner financing into these deals, running multiple comps on multifamily entrances and exits, single family entrances and exits, assures us literally 99.9% we will not make a bad deal.
That's awesome. So you do have to do your due diligence. You did make a point earlier that I kind of want to bring back because I'm in a similar boat as well. I realize that there's, being in the space with people that are doing things and being like in the know, because you're at all these events, you're pretty much plugged in these communities, these masterminds, all this stuff. You really start to learn why people are starting to drift towards hotels. Why are people drifting towards hotels? And then you start really learning about it. And one thing that I realized, and maybe you can talk, to this as well, is, if there's a home on the same block with the same, same comp, 2-bedroom, 2-bath, 2-bedroom, 2-bath. This one makes $150,000 on Airbnb. This one makes $50,000 on Airbnb, or not, or $0. They're valued the same, yep. Right? But when you get into commercial, for a single family home, yes, correct. But when you get into commercial hotels, things like that, a simple repositioning and better marketing can already stabilize the property at 2x. So can you maybe talk about your hotel and how the power of building wealth through commercial?
Yeah, so I mean, it's exactly what you said. I mean, I built a brand new beach house in Gulf Shores that we closed on, essentially Thanksgiving of last year. I'm in for $1 million. 300 bought the sand, the lot for 300, $600,000 in construction costs. I know the numbers to a T because I literally just submitted cost segregation information last night. And basically $104,000 for furnishings and amenities. I've got, like everybody else, bikes and kayaks and coffee bars, and and this was the highest end furnishings that we've ever done. And if you remember when I did my presentation, you were there in Nashville and I showed you the same house, everything that you're talking about. Well, that house down the street, I know that banker. My house today is worth about 1.85 million. His is worth about 1.7 million. So it's increased dramatically in value. But if I took that 6-bedroom, 4-bath with a pool, and it was 6 1-bedroom units, right, with bathrooms with a pool, and I did the same amount of revenue, I'm going to do about between 345 to 360. I'll close out the first 12 months, right? So that 345 to 360 does not and I'm talking about my rental revenue, that does not impact the value to the single family home. It might a little bit if I put it into Airbnb homes for sale group and an specific investors looking to buy it. But in most cases, even though we give rents, it's based on the appraisal, based on the comps being sold as any other single family home. Yeah. If I take that and break that down into units and it's multifamily, all investments are the same, all revenues are the same, my P&L looks the same, my NOI is the same, but now I go and I sell that as a multifamily product with a T12, that's the 350,000 in my trailing 12 months. I can get a 3 to 3.5 time multiple on that. Right. So what is 3.5 times 350,000? I'm not real smart. So I'm going to pull up my phone and I'm 350,000 bucks times, of course I screwed it up. 350,000 times 3.5 is $1.225 million just based on the revenue. Then let's go and factor in the equity inside the property, right? So if I go add that at 1.8, now I'm looking about a $3 million to $3.1 million transaction, as opposed to just selling the asset, the dwelling, the land for 1.8 million. So that's how you can literally add 65 to 80% of value. And when you get more units, you're going to expand it as well. So it's one of the reasons I was 3 minutes late, Patrick. I'm on the phone with one of my 2 bankers in Gulf Shores because we just made an offer on a property yesterday. There's not a whole lot of multifamily down in the Gulf Shores, Orange Beach. You got to go, even through Destin, there's really not. You got to go all the way to old school Panama City Beach to really find some multifamily that could do some ARV too. But we're working on a duplex right now that we're negotiating with. But we're even on a duplex, we're going to get a multifamily funding for an entrance and we'll figure out how to get the multifamily exit on the back end as well.
That's awesome. So going off of that, what's next for you, Bill? Like what are you working on currently? What are you working on next? How are you positioning yourself for the people that are intermediate and are looking to scale or get to the next level? Like what are you doing? Maybe that will draw some inspiration.
Yeah, I mean, I think there's a couple of things. It's what I'm doing, but also I'd say what I'm involved, what I see is probably more important for the beginner or novice or intermediate investor. And kind of what I see through Bill and Kenny's hot picks. I think you met Kenny Bedwell from STR Insights. We have a program called BK Hot Picks, to where we're analyzing properties all across the country every day, and we deliver our members 15% gross ROI or above. So that should be 30% cash on cash with a 20% down. Those are fewer and far between, obviously, than what we saw 6 months ago. And we're not seeing those in Gulf Shores. We're not seeing them in Destin or Broken Bow, Orlando, the Smokies. We're seeing them in places like Maggie Valley, North Carolina, or not even, if you're familiar with Asheville, it's not even Swannanoa or Black Mountain. It's Hendersonville, it's Bryson, North Carolina, it's Maggie Valley. It's why I'm investing into Hot Springs right now. You look at places like Memphis or legit Toledo, Ohio. There's a lot of urban that people are investing into now, where it was all vacation rental previously. The standard rule of thumb is this: if anybody's talking about it on social media right now, it is not a place to invest, period. Right? And even if you can probably save 10 or 15%. So Bill, you just said you put an offer in Gulf Shores. It's not a single family home. It's a duplex. So that gives me 3 opportunities for 3 different types of pricing, 3 different types of marketing. I'm creating more channels to be able to book that property, right? So I look at single family homes. Kenny and I have not seen a property now at 113 days over $1 million that'll do 30% cash on cash. Let that sink in. $1 million listed on the market will not hit 30% cash on cash unless it's just not going to do it. So most of the single family homes, I've got a rule right now. For me, it's pretty much $650,000 or less. And we're seeing some of those in Island Park. We're seeing them all over Western North Carolina is like one of the hottest places to invest. Still the Beach down in Texas. Gulfport, Mississippi has some really good deals. But you got to take that personal bias of, okay, it's Rocky Beach, it's Mississippi, it's Texas, the water's brown, it's not Destin. That's okay. Not everybody can afford to go to 30A, right? Not everybody can afford $15,000, $20,000 a week for a 4 or a 5 bedroom property. And if you want to go invest there and do that, great. But just understand you're going to pay $4 to $5 million as an entry point to be able to get in there. 4 bedrooms, 5 bedrooms, literally tier 7 to tier 10 are going for $1.8 to $2 million in those markets. The pro forma does not justify that, right? So what's really important for me is what I look at. I look at as many properties as I can. I look all over the country every single day. Kenny and I have 6 VAs that are going through STR Insights looking for those and then delivering us the top properties, right? So what happens is I plug those in. When I see those top properties, I plug them into my pro forma. And my pro forma has a no or go no, sell inside of it. And essentially for me, that's 25% cash on cash. But if it's going to go below 30 to 25, that better be yielding over $150,000 net on a property. I'm not willing to compromise below 30% if it's going to be below $150,000 net. That means I typically got to do around 300 to 325, 335. I'm typically doing about 45% net margin. So I might even need to push 350. Don't see those in single family homes right now because they're inflated everywhere. That's the problem. So rule of thumb, just to summarize, 650 or less in markets that people are not investing to. Instead of looking in Scottsdale, look in Glendale, look in Tempe, go to Tucson and look in Tucson where nobody ever talks about Tucson, instead of, Santa Fe, New Mexico, look in the outlying areas around it, go even farther north, closer to Denver. But here's the big things. You got to have the traffic drivers. It's very evident in Blue Ridge, Georgia, and that whole North Georgia mountains that are getting crushed, and they even did over the summer, and they're really getting annihilated right now. There's no traffic drivers. Well, Bill, you're in Banner Elk and Beach Mountain, North Carolina. What are the traffic drivers there? Well, App State and Boone is playing UNC tonight. It's sold out. You can't even get tickets. 60,000 people driving in from all over that region. I mean, it's not going to affect me. I'm too far away. But if you're in Blowing Rock, Boone, those are traffic drivers at university. I mean, you want to do some midterm stays up by Boone, then you got the compression events, the football, that type of stuff. Then look at Furnish Finder. You know, I'm talking non-traditional vacation rental stuff. Right now, if you're down where I am, Banner Elk, and then up on Beach Mountain, we're coming into ski season. But you've also got tremendous hiking, river rafting, all that type of stuff. But skiing is the big deal, right? So we're just getting ready to go into season. One of the reasons that you look at the Smokies, it's sure they've got Ober to ski, but it's proximity to Knoxville, proximity to Nashville, right? They've also got Dollywood. They have every one of those 3 small towns has their own entertainment inside of it. There ain't shit in Blue Ridge, just like there's nothing in Broken Bow. We don't hear as much about Broken Bow because there wasn't as much consolidation, as much saturation, volume of properties, but they're getting crushed there as well, right? So that's one of the, Bill, why Hot Springs, Arkansas? Because of the casino, the horse track, the bathhouses, the lake, and the state park. 5 traffic drivers. We could lose 2 of them and be fine. Probably 3 of them and be fine. So you have to look at the traffic drivers in new markets.
That's awesome. And so, Bill, do you ever invest in transient markets, or it's usually you're always looking for the traffic drivers to those markets?
Define transient.
Transient, more so like along the route, motels, hotels, or single family homes, you know, that kind of thing. You don't do
No,
that?
you know what? One of the biggest influences in my life was a business partner named Reg Booth. Him and I built a $30 million glow-in-the-dark miniature golf course business around the country, to where you'd walk into a shopping mall and you'd go play glow golf, right? And we created that, and we didn't go to strip centers. We didn't go to any transient locations. We went to the shopping malls, and the big ones, like an Opry Mills Mall here, if anybody's in the Northeast, like a Natick Mall or Natick Mall outside of Boston, or Sawgrass Mills down in Fort Lauderdale. If you're in the Phoenix area, you know, Arizona Mills. We went to these places that had built-in traffic, right? And a lot of people would say, oh, well, you like focused on these Mills properties. They had the whole entertainment. They had Dave and Buster's. They had IMAX movie theaters. Great. That drives traffic. Well, you can't compete with them. We were like this Toyota. We started the industry. It didn't exist, but we were the Toyota of the industry. We weren't the Mercedes. But we stayed in the price point that those people wanted. We competed at right similar ticket prices to like the movie theaters. And what an average kid would, what the parents would give the kid to spend in quarters inside of an arcade. And we gave them a unique, different experience. Do the same fucking thing in short-term rentals. So I'm not going to go halfway between Vermont and Maine. It may have 200,000 cars going through that highway a day. But if there's nothing to make them stop, I'm not interested. Right. So I do try to find the ancillary markets outside of the primary market. Right. I love Fort Morgan as opposed to Gulf Shores. I've only moved into Gulf Shores because I do deep research, even when I'm already in a market. And I was probably one of the first people, if not the first, to identify as an investor 2.5 years ago what was happening with the airport there. So I sold every asset I had in Fort Morgan and moved it closer to West Beach, which was the prime area, bought land, built, bought existing houses. I flipped 9 houses in less than 16 months so I could level up and I didn't have to come out of pocket. And now, and I brought my friends down there with me, right? So they could make these investments. Well, now I just found out while I was down in Miami that the first commercial flight is supposed to land in 3 weeks. I forgot the date. It's like the end of September. So now you're taking a market that has strictly been drive-in, and the John Edwards, I think was the name of the airport before, John C. Edwards Airport is now Gulf Shores International, and flights are starting. So you old schoolers that are out there that are listening to this, and you remember what happened, and you know, when you could stop flying into Fort Walton Beach and have to make 2 connections, go through Atlanta, go through Dallas, and then you could fly direct on Southwest into PCB. That's why 30A blew up and it did what it did. And that, my friends, is what's going to happen with Gulf Shores over the next 5 years. even if the fucking market tanks and we see my $1.8 million house come down to 1.4 million, I'm not worried, because I know what's going to happen once we get through this phase, because everything comes back, right? And that airport is going to change everything.
100%. And I think, Bill, I think that's what is really interesting about you is you don't invest for only current cash flow and profits, but also future appreciation of the market itself. You see these different factors that are going to be affecting the areas that you invest in, so that even if you make an okay deal, with time, it becomes a great deal. If that makes sense.
Yeah, I mean, kind of the same principle. It's the deep research, right? And I am looking, down the road. I do not factor that into my performance. I only buy based off of the rental income and the cash flow. I never factor in equity growth into making the decision from the pro forma. I'm basing that on cash flow. But I do look at that equity for the long term. It's one of the reasons that we're in Hot Springs, Arkansas right now, because of that deadline of November 1st. And they pulled 500 permits down to 400, right? So it's going to be Asheville. It's going to be closed. And most people won't be able to start now and try to identify something, and they get financing and appraisals. Even at this point, September 1st, in 2 months, that's going to be challenging. And it's going to be really challenging for people if they want to buy one of the vacant, motels that are there in the multifamily space. So that's why we've got multiple properties under contract. We can probably squeeze in 1 or 2 more, depending on, how fast we can get through that deal. But that's going to be critical. And, there's a place I really want, and here's where the bias comes in, right? We all have to be self-aware enough to identify this, because it can really screw you in the long run. I found a commercial multifamily property in Asheville, North Carolina, new construction, 1,800 square feet of commercial. On the bottom could be subdivided into 2 900 parcels. That'll probably generate about $65,000 a year in long-term rent income, triple net. But there's 4 2-2s on top of it, with permits inside the city limits of Asheville, and a sweet rooftop deck, right? They were at, I forgot what they were asking. Maybe it was 3 million or 3.5 million. Just couldn't get the numbers to work. I wanted it, so it's brand new, it's beautiful. Walk to downtown Asheville. I know, when you talk about that appreciation play, I know that like 5 years from now, it's a $5 to $6 million property, but literally it was like negative 2.3% cash flow. So I'm not willing to sit there with the old mentality of let's buy an LTR and let it sit and just base my investment off of appreciation, because I'd have to put a minimum of probably $1 million into that property to close it. And I can generate more cash flow and appreciation in a different market and in a different property.
So, Bill, I love what you just said there. Let's talk about active versus passive income, because I think a lot of people want to just park their money and wait for it to grow. But a lot of times it's about finding those value add deals or things that are a little bit more active, but tend to generate higher returns now, because your cash on cash is important, right? So I think people starting out can't just park their money unless they want to wait 10, 20 years or 30 years before they really reap the benefits of that real estate.
Yeah, I mean, I don't think if you're going to do any type of self-management, a lot of people think that STRs are passive. I don't believe that it is. I think a passive is like investing in my fund or anybody's fund, and being a limited partner, right? That's a passive investment into real estate. And you can do Brandon Turner's, Open Door Capital, Uncle G's, Cardone Capital. You can do ours, whatever. That's passive, but you're not going to get the return, and your money's tied up. You don't get to determine when you. If you're an accredited investor and you make $100,000 investment or $1 million investment, and you have a life experience, then now you got to get your hands on that 100 grand. You're locked in. You don't get it, or that $1 million. That's the risk. You might make 8, 10, 12, 15% annualized return on that, which is pretty solid, much less risky than being in the stock market today. But one of the reasons I'm a GP, right, as opposed to an LP, and I'm putting the whole fund together. One, the people that invest get to rely on my investing and hosting skills, which I'm not going to say I'm better than anybody else. They can make their own decision. I think I'm pretty solid. My track record speaks for itself. But 2, I'm investing on my own still outside of the fund, because I want to have that control of the cash flow. So passive in real estate, I mean, if you look at the traditional multifamily funds, it's like 8%, annualized preferential rate, right? So 8% is not good enough for me. I make it clear. I typically won't do anything that's going to generate less than $150,000 a year in cash at less than 30%. If it'll do 150 plus, I'm depending on appreciation, I'm willing to come down to potentially in the low to mid 20s. So I can passive income 8%. If I can just do 24, that's 3x. If I can get that to 32, we're talking 4x, right? And my portfolio during the pandemic, we've been pushing pretty close to 37% cash on cash portfolio wide, which is fairly strong. Now I'm conservatively pulling that back to where I think I'll be in the probably mid to high 20s over the next 12 months, because I am not bullish. I am very bearish on what's going to happen over the next 9 months. I think we'll be fine going back into the summer. And like most people, I've already got bookings for next summer in my summer properties. But you know what I don't have? I don't have that many winter bookings for my winter properties that have been newly listed in the spring and the summer. So that could be tough.
So are you balancing your portfolio with different seasonality like properties? Like can you maybe talk about diversification of your assets? And
yeah, so a lot of people kind of just assimilate me in Gulf Shores just because I use that as an example all the time, that I'm the Gulf Shores guy. I've got property, I've got mountain properties, I've got lake properties, I've got West Coast properties, I've got East Coast properties. So big difference having a place in Estes Park, Colorado, even though it's in the mountains, than it is, having a place in Banner Elk, North Carolina, or right up next to the ski slopes at Beach Mountain. So I kind of treat my portfolio and how I build it, one, for lifestyle. So I'm much older than you are, Patrick. I don't know if you knew that or not. I know I look pretty young. I'm just kidding. So, I mean, I'm 49 and a half years old. Initially, my retirement plan, when I built it about 7 years ago, and this is a key component, I built my retirement plan, right? So I don't talk about this a whole lot publicly. I kind of save this stuff for like my mastermind meetings and everything. But I built my retirement plan with a huge mentor of mine named John Baird. And we got very intentional and very specific. And what I found out is I didn't really know what I wanted in retirement. I didn't know when I would retire. It's not like I have a job and I work in, a factory and you retire at 65 and they give you a $300 gold watch and I have a pension at $2,000 a month. So I felt like I was too young. At the time, I was 42 years old, and I probably felt like I was your age. So John Baird, who was a mentor of mine, he former CEO Coldwell Banker Barnes Canada. He turned him around from like $120 million loss, $280 million profit in 3 years. Angel investor, technology, all this type of stuff. And I remember when I was in EO, the Entrepreneurs Organization. I dropped out after a shitty experience, took my top 3 people in my group, my forum, started something called Spark, our own, mastermind group. And we called it Spark because we wanted that spark. We weren't getting it, right? And our responsibility was to spark everybody else. First thing we did was we hired John Baird. I hired him to come in. First thing he did when he came in, all right, boys, he was treating us like we were his managers, like mid-level managers. Be on time or the door's locked, whatever, show up late, $100 fine, it's going to fund our trips, all this type of stuff, just hardcore. And we didn't go over our financials. The first thing he said, I know you guys want to be like me. You want to be old. You want to be retired. You want to be a multi-millionaire. I've had exits. I'm an angel investor now, blah, blah, blah. But you don't want to fucking be like me, because he'd been divorced. I think it was 3 times he'd been divorced. And he started helping us build our life plan. And it was specifics, right? So if I ask you, define retirement, Patrick, what does retirement mean to you?
In my eyes, personally, it means having the financial and the time freedom to do whatever I choose to do at any given
bullshit point. Response. It's the same fucking thing all of us say. I said the exact same thing. You got to think of it like a football game, right? If Peyton Manning drives all the way down to the 10-yard line and throws you the pass and you catch it inside that thing that says Indianapolis in it, and then all of a sudden you see on the 1-yard line, Tom Brady, they've got the ball and he's going down the field, and then he throws it to whoever inside that thing that says, Tampa. I know Peyton doesn't play anymore. I'm not that stupid, but and then what happens if there's no score on the scoreboard? They just throw into these end things, and then come back. It's not you get 6 points when you score in the end zone and then you kick a field goal, right? You don't have Adam Vinatieri out there. It's they're just going back and forth. That's what you just said. And that's what everybody says. I did the exact same thing. Bill, what the fuck does that mean? That's exactly what he said to me. I said, I don't know. He's all, that's the best answer you've given so far. Okay. How much money do you need when you retire? I don't know. Okay. What are your expenses now? Then let's run it on inflation. Do you have any desire to have a vacation home? At the time, I didn't own a vacation home. No, never thought about that. How are you going to get there? You're going to buy an RV? You're going to fly? You're going to buy a plane? You're going to... So we go through all these scenarios. Long story short, what you said is you're flying that plane around, LaGuardia, just circling Manhattan to burn the fuel at 30,000 feet. We got to bring that thing right down on the runway and be very specific because we can't measure it. If we can't keep score, if we don't have date set, so we don't have that clock to run out, then we don't really have a plan. Does that make sense? So the first thing he did, and I built my own success planner after this. First thing, page number 1, what are my 3 life goals? Be a great father, have $15 million in liquidity with no debt when I retire. At the time, it was the age of 60. So I had that date on my calendar, right? But then it manifested out to where he made 3 months later, we're signing a contract with our spouses. All the way down to how much time we're spending with our family, how much time we're spending with our kids, budgeting what the weddings are going to cost for my two daughters, budgeting what college is going to cost, and defining specifically what retirement looks like for us. That's when me and my wife got into short-term rentals, 2015, because we knew we wanted a beach house. We wanted a place in Scottsdale, which we'd had before to play golf. I'm an ex-golf professional. We knew that we wanted to have a lake property, a mountain property, and we knew the one place we don't have right now is we wanted to be in Montana. So we were buying lifestyle assets that would cash flow and essentially have no debt 13, 14, 15 years down the road at that point. That would help fund our cash flow if we truly wanted to disconnect. So the goal was $800,000 in income just through short-term rentals. The problem is I grew too fast and I got to where I owned 13 properties at one time, right? I didn't want to work that much because it's not passive. So I pulled back on that and I've sold properties and I'm actually narrowing my portfolio down to the goal to keep it below 10 because we don't measure our success by the number of units. It may seem that way publicly. I make more money than most people do that have 50 to 100 units. I'm making over $1 million in co-hosting and a portfolio that I own 10 units right now, right? I don't need to have 20. I don't need to have 30. I'm also now ready to retire. Instead of when I'm 60, I'm 49 and a half. I'm ready to retire at 54 and a half. There's also another life event, right? So that means that my youngest daughter will be out of high school. She'll be in college, but it's okay. I've got 529s maxed out. I've got $400,000 each ready to pay for their college. I've got $150,000 for their weddings. I've got another $2.5 million socked away for them to start businesses, to do whatever they want. Right. My oldest daughter wants to become a doctor. That could cost me $1 million plus just in education over 10 years. So I'm planning all of these things out. But most importantly, back to what you said, the result is time freedom and whatever the fuck I want to do when I hit my financial goals and I've taken care of my family. When I'm very specific and I can hit those things, then I earn that other stuff. Most people think I'm going to work towards time freedom and I'm going to travel the world. Those are the 2 biggest things, right? And so I also have a budget for how much my wife and I are going to spend to travel between our own properties, which we can use a lot of that for tax write-offs. That's another interview with Ryan Bakey, or we'll talk about that later. And to go to wherever we want to go. So I've been to a couple of places that she's never been. I got to take her to Peru and go to Machu Picchu. I've been there. I got to take her to the Galapagos. I've been there. So those things we're budgeting now. I know for us to go to the Galapagos Islands, the way we want to do it, it's going to cost about $22,000 today. So if we do that 15 years from now, I'm guessing right now, and I legit, it's like, I think it's like I added like $55,000 or $6,000 to that cost.
Yeah.
If we don't plan this detailed, we're not going to hit our goals. It's the same thing that I see when people are buying properties, Patrick. Okay, AirDNA says this on the free version, I'm good. I'm going to pay $600,000. AirDNA says it's going to do $100,000 in revenue. I don't need to get the paid version. I don't need to do all these pro formas that Bill's talking about. And then those are the people that end up upside down 5 months from now, unfortunately. They don't factor in the carry costs. They don't factor in all the expenses. They're not factoring in for inflation. They're not looking at what the market trends are. They're not looking at the pacing feature inside AirDNA to see occupancies and pricing for properties that are sold versus that are still on the market, that are available to rent. The depth of how we go in our evaluation process, running our own personal financials and planning our future is what's going to determine our success or not, because a lot of it's going to be distilled down all the way to these things, which are daily decisions. And you notice everything on there, I can keep score. Every single day I keep score with what's going on in my life, because if I don't, then I'll fall behind.
That's awesome. So you're basically saying that you have to be intentional about your goals. You can't just say, well, I want to be financially free. It's very generic. It's not precise. You have to really boil down. And I tell people this too. Actually, Mike was the one that introduced me to this because I'm in his mastermind. He talked about how to be intentional with what your perfect day is, and then structure yourself to get there. And like, how much money does that really take? And I think that was.
But you can't really define a perfect day unless you know what your perfect outcome is first. Right. So that doesn't matter. How old are you?
I'm 25.
So you're 25, I'm 49, right? I'm almost a quarter of a century older than you. It doesn't matter if you're my age or if you're at your age. We don't know what that looks like if we don't know what we're working towards, right? So, and it's way harder to do it at your age than it is at my age. But we've really got to figure out what we want. And man, when you're 20, 24, 25, 26, I thought like 50-year-olds were dead. They were in retirement. They look so old to me. But now I look at it, I still feel like I'm in the prime of my life, that I'm probably going to live another 30 or 40 years, right? So if I don't have my head wrapped around that, and it's not just about thinking about it, it's about building out a plan. And most important, this is what I do at my couples retreats, right? You build out your plan and then you sign it. You are signing it with your spouse. You have to be in alignment. I assume you're probably not married, so it's a little bit different. You're thinking for a party of one, most likely right now. I'm not even thinking just for a party of four that includes my spouse. I have 2 daughters. I'm thinking, what if they get married? That's another 2 people. Now I'm thinking about 6. What if they have 2 kids? Now I'm thinking a party of 10. And those are things that we look at down the road. My oldest daughter is 16. You know, if I look at the trends now, she's probably going to have a child in the next 8 to 12 years.
Well, you're anticipating that as well. So I'm anticipating I'm going to get married. I'm going to have kids, right? So like, just because you're older doesn't mean, like, when you're younger, you should also plan for these kind of things. Like, if you know you want to have kids, factor that in. You know, you're going to have to.
Here's the difference in the execution.
Right.
Most younger people, myself included, think about it, but we don't execute in putting a plan together. That's the difference maker, right? I'm the fattest I've ever been in my life right now. You know why? Because I haven't built out a freaking plan to remedy that. I want to do something about it. And I've been fat before and I've lost 80 pounds, right? And right next door is a gym. Not like down the street at Gold's Gym. I've got a full freaking gym in the room next door. My wife's a fitness coach. I want it, right? Just like you want financial freedom when you retire. But I haven't executed on putting a plan down yet. And I know myself that as soon as I put the plan down, then I will execute. But for whatever reason, I haven't had the motivation to do it. And that's the problem when you're young. It's getting that motivation to get to execution. Does that make sense? Because you think it's so far off. I don't need to think about it today. You know, we don't even listen to financial planners at 24. Make sure, you know, if you put $200 a month away for until you retire at 60, it's gonna be worth 1.3 million. You know, today I'm thinking, fuck that. I'm putting 600 away every month. I'm not going to go to the bars. I'm not going to go on that vacation. I'm not going to buy those Gucci shoes. I'm committing to that first. It's just the younger we are, the mentality is not there as a whole, right? So the execution to define and document, execution, decision, define and document, in my opinion, is what will really change the game for most people.
Yeah, that's awesome nuggets. And maybe let's dive more into that, right? So I'm curious, because you're part of, you have your own mastermind and you have students and you see the students that fail and the ones that succeed. What differences depict the ones that really do well and the ones that don't?
Number one is just engagement. Like you kind of mentioned it earlier, you were at my national conference. I saw you at TJ's, you're coming to mine and, mine and Mike's in Miami, you're running your own, just like, what is that? 1, 2, like 4 or 5 different places. And then you're in Mike's mastermind, right? You're surrounding yourself with people that are on the same journey. Just, by osmosis, you're going to learn, even if you're just there to do whatever. There's 2 gentlemen in my mastermind that have, are also in Mike's mastermind. They were both in Miami with us. One is just, he's very, very driven like myself. The other doesn't know his numbers. He's not in the weeds and the details, right? And so I called him out on it and I said, look, that was fucking embarrassing what you did. You get up and you're presenting on a property and you don't know anything about your financials. So now my goal is to ensure that he gets to that point, that he comes, he's here, I'm here. I don't expect him to come all the way over to my side, but we've got to meet in the middle somewhere, right? Because he's going to make some mistakes along the way, and I can't allow somebody to make those mistakes. I think it's mindset is number one. Really, actually, number one is mindset to become inclusive. And so, like, I've got 2 rules in my mastermind. Rule number 1 is you have to give more than you expect to return. And we define that. That means that you have to be at every meeting. You have to do our benchmarks on a monthly basis. You have to be on the calls, and you need to be a giver, because if you're not going to get anything. You're not going to get what you want in return. And we have a no asshole policy. But we also have other requirements that they have to meet to remain a member, because that's the discipline that I need to move people forward, right? Because I've learned it through myself and other masterminds that I've ran. For me, it's not just the money. Hey, come in and you know what, you can go fuck off and do whatever you want. You've already paid me. That's not the deal, for me. So I want to have life-changing experiences. A lot of people, when they come in, they want me to change those things for them. So literally, I flew home yesterday. The night before was we do activities in our accountability groups in the afternoon, right? Then I pull them back in at 8:30 and we wrapped up 2 nights ago. And I said, who's thinking differently? Or I asked a question. And a lot of people raised their hands, probably like 70. And a lot of even the OGs that have been to 6 or 7 meetings in person. Because then I know I'm doing my job. Because my job is leading a mastermind or teaching or being an educator, just like any teacher at any level, from 1st grade to 12th grade to a professor. It's not to do it for them. It's to open their eyes to doing something differently. And most importantly, getting them to think differently. If I can get my people, whether it's a free coaching call in my Facebook group, in my mastermind, it doesn't matter. But if I can get them to change their thought process, just to open up their horizons, and most importantly, I think the number one thing, Patrick, is most people think small. And when they think small, they achieve small results. I was fortunate enough to be raised by a single mother that never made any money in her life, probably never more than $50,000 a year. I didn't grow up dirt poor. Everything was fine. But you know what? We sure as hell were not at probably the bottom of middle class. But she thought big. And she was a teacher and she started her own business. She literally started a preschool because that's what she wanted to do to help people, because it was ridiculously expensive. And she wanted to serve people like herself. The single mother, what does she do with me when I get out of school at 3 and she works till 5, or she had 2 jobs working and if there's anybody old watching this, remember Mervyn's? You don't know Mervyn's, but that was like a West Coast store chain that, man, it probably went away in the 80s. My mom literally worked at Mervyn's at nights after being a teacher because she didn't have enough money. Once again, I didn't starve. We were fine. I'm not giving like a sob story. But what does she do with me from 3 o'clock till 10 o'clock at night? Can't afford that stuff. But she thought big, and she took something that I look at back now that I would never have advised her to go into that business because she's not going to make any money. She ended up leaving me over probably $1.2, $1.3 million when she passed away. She thought she was broke because she thought bigger to do things outside of just teaching and making $35,000 a year and getting summers off. And I think that's the limiting belief that we all have. And it's hard with self-confidence. But one of the things I want to do is I want to open people up and show them, I'm not the guy that had $100 million coming into this. I'm not a hedge fund manager. I can't just go buy what I want. I saved and saved and saved to start with $127,000 to buy my first property. And then it took me 2 years of taking a $45,000 annual rent property to turn it to 112. And then I took the profits out of that to buy property number 2. And then it becomes easier. And one takeaway I want you guys to remember about buying properties and scaling, the hardest property to purchase and the most important isn't number 1, it's number 2. I've never invested one more penny, Patrick, than I did on that very first down payment. I've never had to. I've grown my portfolio to roughly about $13 million in equity right now, with never having to put any more capital into my business. And that's the way that I think people should look at it, because there's people that are going too fast right now. So I'm very conservative in my analysis, but I manage my finances to where when I see a deal, I can move super quickly, right? And that's part of the mindset. You know, Michael talks a lot about mindset. He's into that stuff. And it's really our limiting beliefs, I believe, that hold us back. So the people that thrive in my mastermind are the ones that I can open up their horizons and they engage. Those are the 2 biggest things. The ones that don't engage and don't open up, and we've only had 4 members drop out in the entire history of the mastermind. Those are the 4 that didn't participate and they dropped out.
Wow. Yeah, that shows a lot. And with this looming whatever's happening in the economy, it's more so important to do your due diligence, to run your numbers, and to be careful of what really is happening. And we're being very conservative in our numbers. How are you working with what's happening in this economy right now?
Well, I can tell you right now, I have not. Since I bought that second property with my first property's cash flow, and I waited actually about 25, 26 months to get there. I'm in the longest drought, if you will, of not buying a property. My last property was in April that I closed on at Beach Mountain, North Carolina. So it's been pretty much all of April, May, June, July, August, 5 months. I don't think I've gone longer than 3 months without buying a property for about a 5.5-year run, even pre-COVID. Now I'm just being cautious because I've been in all single family. I've got properties under contract now, motel, duplex, and a single family home. So I'm blending the portfolio and I'm going more towards multifamily right now, because even if I took a hit on appraisal equity, that's okay, because the transaction is going to be on the financial component, right? And I do believe, and it's funny, I have my funding company, Apollo Funding, out of Austin, Texas, was at my mastermind meeting. We were talking about this, and we see some trends starting to happen to where single family bankers will, if you're very well prepared on the front end, and if they are vested into multifamily, they will do some ARV, they will do some multifamily funding on single family homes. And that's kind of the first step, specifically if you have T12s that you can utilize, right? So it's kind of the first step of these banks engaging and saying, you know what, short-term rentals and single family homes are a business. It's traditionally been, it just takes a few of them to kind of get those dominoes, moving. So we've found 2 recently that are giving us funding like that. So it's one of the secrets, honestly, in this business that most people don't do is they don't creatively look hard enough. Bill says DSCR or commercial loan. I'm going to go to one local bank and I'm going to call the lender or Vizio or whoever it is about a DSCR and see what I can do. They're not shopping. Just like they don't run enough data or do enough research on the front end, they just go where it's easy to be able to get money. Mm-hmm. I can tell you that's probably the 2 biggest skill sets I think that I have is the ability, along with my partner John, to creatively basically convince banks, and this is really John can convince banks to come to his terms, right? So if you are really strong in evaluating properties up front, like I'm like top 0.5%, and then you can identify creative funding, because if you're really strong in evaluating, then you have really strong data to be able to show the bank to sell it to them. And then you can get way better financing options that are creative, that may not even be part of the portfolio that the bank currently offers. And we're seeing that in Gulf Shores right now.
That's very interesting that you say that, because we were able to secure funding just by putting a presentation together, like a presentation deck. And people don't realize that, there's a little bit of a leeway. Like, people just think, oh, it's impossible, and then just don't even, commit to it. But when you open up your mind and say, hey, it is possible to work something out where they can feel secure in lending you money and, making sure that the money gets back to them.
Well, a little tip for everybody that's out there. Most people think that you take what you get with a bank. That's the case in most cases with like a DSCR product. But if you're walking into a commercial bank, you need to walk in like you're walking onto a car dealership lot. And the more knowledge you have, the more research you did ahead of time, the better chance you're going to have to be able to negotiate a better deal. Every commercial bank has options. So some of the things that you need to, like that portfolio as an example, every boot camp that I've run, every one of them has literally that package that you talk about in it. And we deliver that. So that way they can copy it and they can see it. And it's not just your tax returns. And the fundamental mistake that people make is they walk into their bank. Hey, Patrick, my name's Bill. I'm looking to buy this property. Awesome. How much is it? Oh, let me pull that up and show you the Zillow listing. Okay. Do you have your PFS? Do you have your tax returns? Oh, do you need that? Just by going through that exchange, the banker sees how inexperienced you are. And you just, you went from 5.25 to 6% on the interest rate. You might be asking for 15% down. No fucking chance. You think you're going to try to negotiate a commercial bank from 20 to 25? No chance. Now I walk in and say, hey, Patrick, I'm Bill Faeth. Nice to meet you. Bill, do you have experience in, real estate? Absolutely. I've got 22,000 students, build short-term rental wealth, $13 million portfolio. By the way, here's my PFS. You can see these properties. Here's market value. I've got about $7.5 million in equity there, yielding off $880,000 in free cash, doing 22% cash on cash. Here's the 6 performers that I've run on this deal already. By the way, here's my PFS. Here's the $969,000 in cash I have at Pinnacle Bank over here. Here's the certified letter. Here's my 2 tax returns. Here's the top 8 properties and their comps. Boom. Bill, what did you want? Yeah, I want 25 years, 4.75%, and I need an extra $150,000 on top of that price for construction. Done. It's completely different than walking 100%. In just asking.
It's all trust at the end of the day, right? Like, can I trust this guy with my money? Right. And you come prepared, you know exactly what you want and exact terms of what you want, and what kind of terms are, flying around. So I think coming prepared is like one of the best ways to get the best rate from my understanding.
So here's the big one. So we have a thing in our mastermind. It's called the mastermind markup, and it was coined by the mastermind, but we do benchmarks. So I know everybody's location, entry price, cleaning costs, revenue, all that type of stuff. And it's roughly 30% over like the 90th percentile in AirDNA, right? So my mastermind as a whole, as an average, is doing like 120%. So and I outperform about 45 to 50% of AirDNA's 90th percentile nationwide. So you know what that banker is going to do when I walk out of there? First thing he's going to do is put my property into AirDNA, right? So I've got to show them too. Here's what AirDNA has on this property through Rentalizer. Here's what those comps are. Here's what my perform is showing. Let them know that you're going to outperform it, but it's not just on this property. I got to go back down into that, attachment that goes into my PFS. It shows all my properties. And when I show them I'm doing 170,000, 290,000, 350,000, I got to run those properties through as well. Give them the addresses, tell them, here's AirDNA, here's what I'm doing. So that way they see the track record. That is so critical. And almost nobody does that when they're walking into a bank.
100%. I agree with you. 100%. I do have a few like exit questions before we wrap this up. So what advice would you give to somebody that's starting out? I think this is a common question.
I think it depends on their financial situation. I think it depends on their work situation. I think it depends on their family situation. There's I hate to answer it this way, but this is the deal about me. Most people are going to say, do this. Go buy a property, start with arbitrage, go co-host, do whatever. I believe in knowing and being known. I am not comfortable giving blanket advice, so I'm going to do this a little bit differently. If you are 24 like Patrick, but you have no money, you're like straight out of, college and your dad gave you $5,000, to go out on your own, then I would highly recommend that you go into co-hosting. Subscribe to Airbnb Automated, listen to STR Secrets, listen to my podcast, STR Unfiltered, get in our Facebook groups, consume every fucking thing that you can, every morsel of content for free around like co-hosting. You don't need to go watch my stuff about investing and cost segregations. So you got to understand what you're getting into, right? So if you've got no money, co-hosting is the path to go down, but you've got to become an expert in it. And it's not even you need to work for somebody for free for like 90 days and build a case study. Because if you can build a case study, then you have something tangible to show that next prospect. Go join the Airbnb co-host group and never, oh, I want to co-host in Tampa. Hey, I'm looking to co-host in Florida. Well, what's your fucking value? Nobody delivers any value in co-hosting. So go it's easy, create your value. So if you have no money, that's the path that I'll go down. I can give you a master class in like, 15 minutes on what you need to do. Build your case study. Most importantly, become the person of interest. At least 3 to 5 value propositions. Mindset wise, you have to become comfortable sharing your skills and teaching them what to do. Second part of this is, how do you acquire clients? Literally dominate a market. If you live in San Antonio, go to, Port Aransas and just go on Airbnb and search like $1,000 plus on, nightly or $500 plus. Look at the ones that are underperforming. Spend $99, get an AirDNA account, see which properties, go STRS Insights account, see which properties are underperforming. Pick 5, send them your case study and probably a 500-word single-page letter, educating them, telling them exactly what they can do to like increase 20, 30, 40, 50% on their revenue. And it's even better if you find properties that are like Evolve is managing, because they absolutely suck. So I'm targeting them and I'm giving them value to be able to do it on their own. Why? Because my mindset knows there's no chance they're going to do it. Specifically, if they're already using a PM, they're going to come back to me and say, Bill, that's amazing. Thank you so much for sharing. Can you do this for me? Oh, you know what, Patrick? Let's discuss that. I might have an opening in my portfolio to where I can squeeze you in, because I only do this with X properties. But the biggest mistake too is you got to set your bare minimum on how much. So I started at 100 grand minimum on revenue at 18% plus $300 a month. Now I'm 150 to 175 minimum, and I'm at 23% plus $299 a month, which is just my retainer fee. So I would go down that path. I don't believe in arbitrage. A lot of friends, Sean, TJ, these guys that are into arbitrage. I believe if I'm going to go do arbitrage, I'd rather build a co-hosting business, really a management business. I don't use that term because I don't property manage. I don't escrow. I don't own the accounts. I let my clients own everything. And because I think I can get the same sellable multiple off of that I can off the risk of having the leases in an arbitrage business. So I steer clear of arbitrage. I'm perfectly happy with the people that do it because it doesn't affect me. Go do what you want. So I'm either going to own assets or I'm going to co-host. Those are the two ways that I'm going to go. And if you have no money, build up, 120,000 bucks to where you can go in and leverage that to buy into your assets long term. There's a lot of people that don't want to own real estate. Sean Raskovich is an example. He owns nothing. He doesn't want to own anything. He thinks he has the best model. And you know what? He does for him. And I have the best model for me. So understand that we are all, from Avery Carl to Michael Sjogren to Sean, TJ, Julie, Brian Clark, Grant Cardone, Bill Faeth. We all have our own models. You need to build one for you. Don't follow in the exact footsteps of what any of us are doing, because we don't know what's behind the curtain at your house. You're the only one that knows that.
Awesome. And this is for 20-year-olds. Is there any advice you'd give to somebody that's more experienced or has money, I guess? Kind of what would you advise those kind of people to do?
I mean, I'm a believer right now. Like I said earlier, I would definitely be buying real estate. I'd probably wait a couple of months. I'm a wait and see to what happens after the election. I think that our inflation and interest rates right now are being held down, and I think it's going to get a lot worse after the election. And I think that I think the Democrats are going to control everything, after the election. And look, I don't want to get into a political discussion. I don't think it's ever good when either the Republicans control everything or the Democrats control everything, right? I like to see some checks and balances in our political system because I hate our political system. And I think it's going to be a shit show coming in after the election. I think we'll see double-digit inflation. I think we'll see double-digit interest rates. I think it's going to be very challenging. So I'd take a wait and see approach. I'd hate to see you go buy $1 million property today, put $200,000 down, and literally see a 20 or 30% drop in equity and see another 20% drop in stays. And then one, have no cash flow, and two, have an asset that you're upside down in. So I just say be very, very cautious. Hence, that's why the performas become so important right now. And that's also why I'm only buying under 650,000 for single family home, and I'm buying multifamily. But one of the big components here is that our fund and myself personally, I've built the capital to where I always carry at least 12 months carry cost in capital before I make an investment. So when I say I've got like $989,000 to invest, I'm not going to invest $1 million in property. I'm not going to go write $200,000 checks. A lot of that is for carry costs on properties that I already have, and also properties that I might purchase, because I am buying, right? So one of the things with money is you have to look at the tax advantages. I mean, I just got Yona Weiss is, one of the go-to guys in our industry for cost segregations, and he's doing one for me right now, and it's on new construction. It's not even a property that's 20, 30, 40 years old that's been rehabbed. $300,000 in land costs, $600,000 in dwelling costs, and I got $187,000 year number one and $222,000 over the next 4 years after that. So that's a huge deal that I look at as I'm actually factoring in cost seg. And so I have one pro forma to where I factor in cost seg benefit. Ryan Bakey's taught at a couple of my boot camps, and I never looked at it this way. I thought about it once again, that whole documenting and execution, right? So I thought about the cost seg and I kind of average it out to 20%. But then when I see it in the pro forma, it's like, holy shit, how can I pass this up? Because I might go from 30% cash on cash to like 54% cash on cash. So one of the things that's important that I'm really looking for is infinite returns. And that's infinite returns without having to cash out refi, which I've never done a cash out refi. I've never done a HELOC. I kind of live, so you have some context about me, between Robert Kiyosaki and my man Dave, and I'm right in the middle. Dave lives about a quarter of a mile from me, and I want to be debt free, right? And I want to be debt free probably more than Patrick, because I'm 25 years older than him and I'm 5 years away from retirement. Patrick can be way more aggressive today. I literally, if I wish I had short-term rentals when I was your age, because I would be maxing out my LTV as quickly as I can on every single property. And that's how you go from, co-hosting if you have no cash and building up 50 grand and buying a $250,000 property, and then ARV it over the next 9 months, put $2,000 a month of your co-hosting into every month and just incrementally level it up and save your cash flow. And now you might have 12 months down the road, a $350,000 asset. Then you can cash out refi it. Well, today it sucks. It's probably 75%, maybe 80%.
Yeah.
But in the past, you could do 85%. So then you might get another 100 and you put it into the cash that you've saved. Now you might have 150 to go buy a $650,000, a $700,000 property. It's exactly how I did it. I just didn't go stroke checks, to just buy these massive properties. The biggest one I've ever bought today is 1.6 million. And I started this progression of tax preparation and scaling, and it took me a year and a half to turn a $429,000 property, actually, 19 months from the investment in the $429,000 property, 2-bedroom, 2-bath on West Lagoon in Gulf Shores, into a $1.6 million, 2.5-acre lodge at the top of a mountain in Banner Elk that I was projecting 340, 350 when I bought it in early April. Now I'm looking at about 260 to 275 conservatively. It's still a good deal. It's still going to spit off over 20% cash on cash. But now I've got probably $600,000 in equity in that property, with physically $500,000 of my cash, sitting inside of it. So that will probably be the first property that I will cash out refi out of, because that'll be a long-term hold for me. That'll be a retirement home, a lifestyle asset for me. So when the rates come back down, and I don't think that'll be for 4 to 5 years, to be honest with you, that will probably be the first property that I will cash out refi. So in the meantime, since that's my biggest liability, at roughly about a $4,700 a month payment, I've got to make sure that I have that cash. I use the term escrow because I name them escrow accounts, even though they're not like true trust accounts. I have an operating account. I have a deposit account, an operating account, and an escrow account for every property, right? And you talk about profit first, I pay 20% to my escrow account first. I have to keep, if I ever dip into that foreign investment or whatever it is, then I'm filling that first. That's what I talk about, paying the business. Then I pay myself next.
100%. That's amazing advice. Thank you for that. So now another question, is there anything you're currently working on that you would like the listeners to know about? Anything you want to plug in?
I don't really want to plug anything, but what I would say is listen to STR Unfiltered podcast and STRonomics. Kenny Bedwell from STR Insights and I started a podcast a couple of weeks ago. You'll get the no bullshit, real stuff. If you like what you've heard here with Patrick, then that's my jam over at STR Unfiltered. It's a no BS approach. I'm not going to sugarcoat anything. And if you really want to learn how to evaluate properties and what goes into it and what to be looking for, where to be buying, when to be buying, that's STRonomics with Kenny Bedwell from STR Insights and myself. That's really,
I think that's like one of the things that I get most asked is, which market do I buy in? How do I buy? Like, how do I evaluate it? And I think that STR Insights does a really good job of helping people narrow that down, like where to buy,
Kenny,
how to buy, whatever.
Kenny fundamentally changed the way that people like myself that are open to investing nationally evaluate properties. Because it used to be you had to choose a market, find houses available in that market, then go to AirDNA and run the numbers. Well, now it's like literally open up your phone, sort by gross ROI, so you see the most profitable properties everywhere in the country, and then you find the market that you like, and then you distill it down to bedrooms. Right. And then click on the map and you see what's available for sale right now. And you have the comps right there. So he fundamentally he's in my mastermind, and he started working on this around maybe July of last year. And he showed us the first rendition of a spreadsheet in our Gatlinburg meeting in September of last year. And none of us really thought anything about how it was going to change and really open up the entire country for us. But that's the biggest deal. To where, and we talked about mindset previously, Patrick, a lot of people just invest in their backyard. Hey, you know what? I live in Pittsburgh. I'm going to invest in Pittsburgh, or I don't want to go out of Cleveland or whatever it is. There's so much more opportunity. So when you can just open it up and see what's available to purchase, and I'm telling you, anything over 15% gross ROI and STR Insights, that equivalates roughly, I can't guarantee it, but to 30% cash on cash. If you put 20% down, and you don't go crazy, on post-closing numbers. That's so really good. I don't look at anything under 15%, and I try to actually stay in that 18 to 21% range. And that's where we're finding all these new emerging markets. And it's the ones that people haven't overinvested into.
Do you like investing in medium or large markets? Like, what's kind of your strategy? Just because I think a lot of times people don't want to invest into a specific market, get the whole team and cleaning crew ready, and then there's really not much money to be made there, like a few houses, you know what I mean? But like, instead of scaling in the sense that you choose a market, you stick to it, and then you develop your team around it and you buy like 5-10 houses. Like, what do you recommend somebody to do with that data?
I like tier 2 markets. And what I mean by that is, and I'm going to, I invested in Gulf Shores when he was one of my groomsmen at my weddings. Him and his family owns half a Destin, and they have for 30 years, like legit half a Destin. He manages over 1,000 properties and owns like 280 from Fort Walton Beach to 38. And I'll never forget, we were having lunch in Seaside, and I call him Wee. His name's William Wilson. He owns Frangista Beach Rental Properties, whatever the name of his company is there. And I said, Wee, Bree and I decided we wanted to buy a house here. And he's like, okay, how much money do you have? What's your budget? And I said, maybe 650. We've got about 125,000. And he starts laughing. He called me Six, and my nickname was Six Pack. Not because of my abs. That was when we were traveling in Asia and South America. He said, Six, If you want to spend 650,000, this was 2015. We're not talking 2020, 21. We're having lunch in Seaside. I'm like, yeah, I want to be here in Seaside. He's like, okay, well, you're gonna have to go on the other side of Highway 90 or with the scenic highway, whatever it was. I'm like, dude, that's like 2 miles away. He's like, yeah, if you want to be like, if you want to even be walking distance, like tier 5, tier 6, you were already looking at like 600,000-700,000. Yeah, but Bria wants to see, her contingency, she wants to see the beach, hear the water, and smell it. And he laughed again and he said, why don't you go look in Gulf Shores? I'd never heard of it. I mean, I'd heard of it, but I didn't know anything about it. I was a long-term rental guy, right? I was commercial. I didn't have short-term rentals at that point. And so he told me a little bit about it. And I found a property. We contacted an agent. I found a property I liked 2 days before we went down. We were seeing 10 properties, literally from Nashville. You fly in, you land in Pensacola, you land at like 9:45, you drive an hour to Gulf Shores, then there's like a 4:50 flight out. So you've got like 3 hours on the ground if you want to fly in and out same day. Wow. Can't even tell you how many times I've done that. So we saw 10 properties in like the 3.5 hours that we were there. And the very first one was the one that I found on Zillow, just randomly looking a couple of days before it just listed on the market. And that's the one that we bought. It was, and you could see the water. It was unencumbered views. It was called Bella Vista. It was a 4-bedroom, 3-bath that had never been STR'd before. Very unique design. 2 huge decks, 100 yards to walk to the beach. Had everything that I needed to get started. And that's how I was able to take it from a shitty property management company that, you know, basically puts it in their system. I think what are they using, StreamYard or Streamline or something like that back in the day, and they don't do anything. Right. They're not optimizing. Nobody was using Beyond and, you know, Price Labs and that type of stuff back then. Right. Nobody was doing Facebook ads or any of that type of stuff. So literally 3 months in, I fired the property management company that came with the realtor, right? So okay, realtor, property manager, great. You guys will take care of it. You'll rent it. You're the professionals. Worst thing I ever did. And that's how I started, you know, self-managing. So I just had a bad experience. But so that's how I got into Gulf Shores, based on somebody that had way more experience in the market I wanted to invest into, right? So then I look at my next market. I mean, I owned a property in Scottsdale, Arizona. I moved out to Carefree. I took my cash and then I moved out to Carefree. I invested more and that was, and I should say the tier 2 market was Gulf Shores to Destin, but I started in Fort Morgan, right? I didn't start in Gulf Shores and then go out to Fort Morgan. I started in Fort Morgan. Then I bought another property in Fort Morgan. Then I came back to West Beach in Gulf Shores. And now I've got a beachfront in Fort Morgan, if that makes sense. So the reason I came back was the airport, right? So there's a reason I invested in Western North Carolina, because I don't want to be in the Smokies. So one of the things that I think is really critical is you have to look at the level of hosting, right? Meaning, if you want to go into the Smokies today, if you're buying anything above a 3-bedroom, like 4, 5, 6, 7, 8 bedrooms, you got to have kick-ass views, and you better have a $50,000 game room in your garage and a hot tub just to compete. And now Peyton Abernathy's taking it to the whole next level, where he's putting like indoor pools in every one of his houses, and he has the so that's a little bit different. That's unique, right? But literally, game room, views, hot tubs, that's like the barrier to entry, and the people that don't do that get crushed. So that was kind of my jam. I took what I saw in Seaside, the bikes, the paddle boards, all that type of stuff. I put in at that first house, Bella Vista. Nobody had it in Fort Morgan, not even in Gulf Shores. Brand new golf cart, paddle boards, kayaks, all that type of stuff that I started implementing immediately when I fired that property management company after 2 months in the summer. What do you think happened in my neighborhood? My 2 redneck friends that were from Kentucky down there, we call them the Kentucky headhunters, like legit, like literally Morgan Wallen mullets to the extreme. Within 3 months or 4 months of me having golf carts, they bought golf carts, right? And a lot of people get pissed about people copying the stuff that they're doing. My wife, who's turned into a great designer, we upgraded all the furnishings, even though we didn't need to. Well, people in my neighborhood, Morgantown, started doing the same thing. You know what happened? And this is where saturation is good, if the saturation is educated. Overall, that area, the rent started going up, right? I have 13 properties in Fort Morgan just that my mastermind owns. 13 properties, just my mastermind. I know of about another probably 15 to 20 properties that people in my host academy, my library own out there, right? So let's just call it 50 for easy math. There's not much, there's not much volume. You're looking like 2 streets typically in that area. We have dramatically impacted that market to lift up the ADR because we've completely leveled up the hosting. And there's this much bigger separation now between the shitty property management companies and what we're doing, right? So those people that are doing it are lifting everyone else up. That's what I love about masterminds. That's what I love about going to the stuff that you talk about, going to the conferences and learning this stuff, and then connecting with people in those areas to where we can help lift them up as well. But man, I went to Banner Elk and Beach Mountain instead of the Smokies because I saw the pricing, found a hole in the market with my Banner Elk property at like 16 plus occupancy. And the hosting there is horrible. It's now, look, that's the most challenging market I've ever been in for services. For like handymen, plumbers, cleaners, it's very, very hard. It's very, very challenging. Sometimes I want to exit the market because of how challenging it is, to be honest with you. And it should be part of your vetting process when you go into these tier 2 markets. And it's one of the reasons you asked about like small, medium, large. I will never go into a small market. But the competition, even though there's saturation, there's volume of properties in that Western North Carolina area, the hosting is way down, right? Compared to like Gatlinburg. So I can out-host those people pretty easily without having to spend 40 hours a week per property. Now, I'll give you a quick example. If you would have you can't really do this on like AirDNA, Rabble, or Mashvisor, but when we first started got into the alpha testing and the beta testing of SDR Insights, when we were in Gatlinburg, like the second week of September last year in our mastermind, the number 1 town for gross ROI in the country was Logan, Ohio.
Wow.
You ever heard of it?
No, never.
Neither did I. Nobody in the room had ever heard of it.
Yeah.
The only thing they have there from a business, kind of economical standpoint is a sod farm. And literally Logan, Ohio is like 1 mile to a state park. So remember, September of last year was 2021. What are we looking at from data? Trailing 12 months. Crushed it through when everything reopened in 2020 through September of 2021, right? So like we saw prime numbers of a market that only had like 8 STRs in it, but it skyrocketed the gross ROI. You could buy an 8-bedroom property there today for $300,000, right? Not an investable market. Way too small, was only crushing it because of COVID, right? And that's the thing that we have to look at. How did COVID, it affected everything, but how did it affect a specific market? That's why I want to look at historical data. And I also want to look at the forecasted data, moving forward. That's why I use the pacing feature inside of AirDNA. 2019
numbers, pacing. You got to have more data. You can't just look at the AirDNA number and just come to a conclusion that's what you're going to make,
100%. So when you look at size of market, it's kind of irrelevant to me, but I would never go into a small market. So I'm in one of the most saturated markets, Gulf Shores, right? And outside of that, I'm in kind of tier 2, and it's still a tier 2 market to Destin, but there's still 14,000 STRs in that market, which it goes from basically Dauphin Island, I'll kind of throw that away, but from Fort Morgan to Orange Beach. But what most people don't know is that you're looking at like 9,000 of those are condos just in really that whole area, but really concentrated in Orange Beach. If you look at the prime area of a market, and this is where doing some super deep analysis, right? You're looking at East Beach, which is only like 3 blocks long. And then you're looking at West Beach, which is like 4 streets for a mile, right? And then it drops down to 2 streets and then 1 street, which is tier 1 and tier 2 going for 3 miles out to the end. And then a little subdivision with probably 20 homes on the very end. Very similar when you go out to Fort Morgan, right? Once you get into Fort Morgan, you've got basically park on the left-hand side. Then you come and it opens up right around the beach club, and you've got a couple of roads, like 5, 6 roads. So a couple hundred houses. Then you go through Kiva Dunes, the golf course, right? And there's probably 500 houses in Kiva. Then once you get past that, you're at like Surfside, Morgantown, and all the way out in there. It's like 1 or 2 streets. That's it. So there's not that much volume. People think there is because they just look, oh my God, there's 14,000, it's saturated. It's
Yep.
not. Look deeper, pull the layers of the onion back and really look at what's in the core and what's in the center, right? That's where the evaluation process and going deep. If you want to be successful in this business, you have to learn how to do deep, rich evaluations, because it's not just looking at the data. It's a lot of the other stuff that goes behind it when you're evaluating the marketplace.
100%. And when people say saturation, how do you respond to that? Oh, this market's saturated.
I mean,
because I get that a lot. So
I go back to my glow golf business. I mean, I'm bankrupt today if I put that thing, you know, in the middle of nowhere. Nobody's going to drive to come do that. It's not that fun. But you know what it was? It was unique and different to where when we go into a mall, like Opry Mills Mall, which is right next to the Gaylord Opryland and right next to the Grand Ole Opry, right? And it's, you know, people from Nashville come and they do 24 million people a year. 24 million people a year. I only need 1%, not even that, a half of 1% of people to give me $10 to play golf to build $1 million business. So if you don't have traffic, nobody's coming. You're not going to be fucking good enough to educate an entire population to come to your property, let alone, this is one thing y'all better get to your fucking head. Nobody is planning vacations around your property. Nobody's saying, oh my God, look at Patrick's amazing flat in Soho. I'm going to schedule a business meeting in Manhattan so I can go stay in his property. They are coming to your location for other shit. We are secondary. We will always be secondary. I don't plan my vacations to go stay at a Marriott or a Hilton hotel. I decide where I'm going, and then we will get the accommodations once we decide where we're going. If you understand that and you really design, implement inside of your property, outside on the acreage, and then in your marketing campaigns, that's what they're looking for first, you will have a competitive advantage.
100%. Location in real estate, especially in our field, is everything. So like 100%. Cool. Well, I know this has gone a little bit over, but I just wanted to finish this off with, how can listeners really connect with you online? Do you have social media or anything that you want them to visit to learn more about you?
I'm too old for that stuff, Patrick. I'm almost 50, man. No, I'm everywhere. I mean, really, Build Short-Term Rental Wealth Facebook group is probably the best spot. But I'm dropping educational videos on TikTok. It's B Faeth. What am I? B Faeth on TikTok. Bill Faeth 73 on Instagram. You know, I'm pretty much everywhere. We've got.
Look at you. You're plugged in. You're plugged in.
I mean, I'm trying to stay hip with you young kids. I got my captions, my emojis going, everything on my TikToks and my Instagram. I just don't dance on TikTok. I'm just there to educate.
No dances coming up? Well, I don't know if people are going to want to follow if there's no dances coming up.
I'm going to get I'll make a promise to everybody. I'm going to get my boy Walker Hayes, who I'm friends with, and we'll do a dance, but I need some practice. So give me a few weeks.
And that's a promise.
What's that?
Put it on video, so that's a promise.
That's what I'm saying. We'll put it on AA. We'll do it to AA or Fancy Like or something like that. But awesome. You know, if you watch his stuff on TikTok, we got to do it in like a Walmart or something like that, because he's always like shopping at our Publix or Walmart or something.
It has to be in public. It has to be in public. That's the only exception.
But yeah, I mean, you can find me pretty much anywhere on social. I would say that Build STR Wealth, Build Short-Term Rental Wealth. The Facebook group probably has the most value because the members are just incredible in there. It's not a bitch session about cleaners or guests like some of the other groups.
I will say one more thing to anybody that wants to get connected with Bill. Bill is probably one of the most accessible people, in my opinion. You know, he talks to everybody at a conference. He's always willing to give help. He's probably going to be blushing right now when I say all this stuff, but he's really, really a giving person. I definitely recommend even asking questions. He's going to be responding in all the comments in the Facebook group. It's been amazing. So
I appreciate you saying that. I'm not going to blush because it's 100% fact, and it's extremely it's extremely intentional.
Yeah.
So what's different about me is I don't want to sell to anybody. Don't be afraid to schedule. I mean, I do probably 6 to 8 free calls a day. I want to be accessible. I want to give more. I know that if I give you enough value, and that the value add is a shitty term that's just overused by people that don't deliver value. But if I invest into you, I shouldn't have to ask you to invest with me. If I can do something to change your path in 30 minutes or 15 minutes or an hour, then I believe at some point, it may not be today, it may not be tomorrow, it might be a year down the road, that you'll come back and you'll end up seeing something. Wow, I need to go to the STR Wealth Conference. I want coaching from Bill. I want whatever. So, and I run my properties that way as well. Just FYI, I do everything in my life, everywhere in my business. So for me as a coach, and my whole family was sports coaches, and I was a college golf coach as well. And then as a coach in this industry and other industries, trying to help people with their life and business, if somebody is only going to charge you to have a conversation with you or not be accessible, what do you think the relationship's going to look like once you're actually paying them? It's pretty simple in my opinion. So that I appreciate 100%. You seeing that and mentioning that, because it is extremely intentional on my side.
That's awesome. Thanks, Bill, so much for hopping on and your time, for sharing everything you know. So thanks, man.
Yeah, most importantly, don't forget about Las Vegas. I think it's October 14th, 15th. Is that right? STR
October
Nation?
15th and 16th, right.
October
yes.
15th, 16th. I'm going to give Patrick a little plug here for STR Nation in Vegas. What's your URL? Is it just strnation.com?
It's str-nation.com.
str-nation.com.
There you go.
Las Vegas. Who doesn't want to go to Vegas in October?
Yeah, of course. Well, thank you, Bill. I appreciate everything. All right.
Thanks for having me. Have a wonderful day.
All right. Bye-bye.